The market is not your friend. It is your teacher. Most people enter the stock market with one simple dream: to get rich fast. They see stories of people making huge money overnight and think, this is easy. I will also double my money quickly. But the truth is very different. The stock market does not reward excitement, shortcuts, or emotional decisions. In fact, it punishes them. The market does not care about your hopes, your fears, or your urgency. It only respects patience, discipline, and intelligent thinking. Here is the biggest lie most people believe: investing is gambling. No! Real investing is not gambling. Gambling is based on luck. Intelligent investing is based on logic, control, and deep understanding. A gambler reacts. An intelligent investor plans. A gambler follows tips. An investor follows strategy. A gambler looks for fast money. An investor looks for long-term stability and steady growth. The stock market is not your enemy, but it is also not your friend. It is your teacher. Every rise teaches patience. Every fall teaches control. Every mistake teaches discipline. The problem is not the market. The problem is the emotional mind of the investor, who wants quick profit without knowledge, without preparation, and without self-control. This book, The Intelligent Investor, is not about becoming rich in 30 days. It is not about magic stocks or secret formulas. It is about learning how to survive in the market, how to protect your money, how to grow slowly but safely, and how to build wealth that lasts for life. It teaches you how to think like a calm, intelligent, and disciplined investor instead of a nervous, greedy, emotional trader. If you are ready to stop chasing fast money and start building real financial strength, then this journey is for you. Because in the stock market, excitement creates losses, but intelligence creates freedom. And today, you are not here to gamble. You are here to learn how to win, wisely, patiently, and intelligently. Chapter 1. Investor versus Speculator. Most people think everyone in the stock market is an investor, but that is not true. There are two very different types of people in the market: the investor and the speculator. And if you don't understand this difference clearly, the market will teach you in the most painful way, through loss, stress, and regret. A speculator is someone who acts based on emotions. He watches the price going up and suddenly feels excited. He hears a tip from a friend, a YouTube video, or a WhatsApp group, and immediately puts his money without proper thinking. He buys because everyone else is buying. He sells because everyone else is panicking. His decisions are controlled by fear and greed, not by logic. Today, he feels confident. Tomorrow, he feels scared. His money moves according to his mood, not according to a plan. This is not investing. This is emotional gambling. An investor is completely different. An investor follows strategy, discipline, and patience. He studies the company, understands the business, checks the financials, and thinks long-term. He does not care about daily price movement. He does not panic when the market falls. He does not rush when the market rises. He knows exactly why he invested and what his goal is. His actions are slow, calm, and calculated. He treats investing like a serious business, not like a fast money game. Real investing is not about excitement. It is about control. It is not about quick profit. It is about safe and steady growth. A speculator asks, how much can I make quickly? An investor asks, how safe is my money and how will it grow over time? If you behave like a speculator, the market will punish you again and again. But if you think like an investor, the
the market will slowly reward you. This book teaches you to stop reacting emotionally and start thinking intelligently. Because in the long run, the market does not respect speed, it respects wisdom. So the first step to becoming an intelligent investor is simple but powerful. Decide who you want to be: a nervous speculator chasing tips, or a calm investor building real wealth. Your answer will decide your financial future.
Chapter 2. The Role of Mr. Market. Benjamin Graham explains the stock market using a very simple and powerful idea called Mr. Market. Imagine the market as a real person who comes to you every single day with a price for your shares. But the problem is, Mr. Market is not stable. He is emotional, moody, and completely unpredictable. Some days, Mr. Market feels very excited and overconfident. He believes everything is perfect. He offers very high prices and tries to convince you that this is the best time to buy. Other days, he becomes sad, fearful, and depressed. He believes everything's going to collapse, so he offers very low prices and begs you to sell. The mistake most people make is that they listen to Mr. Market like he is their boss. When he is happy, they become greedy and buy at high prices. When he is scared, they also become scared and sell at low prices. They let his mood control their decisions. This is where most losses happen. An intelligent investor does not follow Mr. Market. He understands him, he observes him, and instead of reacting, he uses Mr. Market's emotions to his own advantage. When Mr. Market is depressed and selling cheap, the intelligent investor buys good companies at low prices. When Mr. Market is overexcited and pushing prices too high, the intelligent investor becomes careful and avoids risky decisions. Mr. Market is there to serve you, not to guide you. You are not forced to accept his prices every day. You can say no, you can wait, you can choose the right moment. The intelligent investor treats Mr. Market like a foolish salesman whose job is to offer prices, not give advice. This chapter teaches a very important lesson. The market's job is to behave emotionally, but your job is to stay logical. Do not let the mood of the market become the mood of your mind. Calm thinking plus patient action is what protects your money and grows your wealth. Remember this simple rule: do not obey Mr. Market. Use Mr. Market, because those who follow his emotions lose money, and those who understand his nature build fortune.
Chapter 3. Margin of Safety. The most important rule in the whole investing world is called margin of safety. This is the golden protection rule that separates smart investors from people who lose money again and again. Margin of safety simply means buy only when the market price is much lower than the real value of the company. Think of it like this. Imagine a shirt in a shop costs 1,000 rupees, normally. But one day it is on sale for 500 rupees. You know the quality is good, brand is good, and the real worth is 1,000 rupees. So when you buy it at 500 rupees, you are safe. Even if something goes wrong, you are still not overpaying. This extra gap is your safety cushion. In the stock market, it works the same way. The real value of a company is called its intrinsic value. The market price goes up and down due to emotions, news, fear, and excitement. When the market price is far below the real value, that gap is your margin of safety. This margin protects you from wrong calculations, market crashes, economic problems, unexpected bad news. No investor is perfect. Everyone makes mistakes. But margin of safety reduces the damage. It is like wearing a helmet while riding a bike. You may still fall, but your head is protected. People who don't use margin of safety buy shares at high prices because of hype and excitement. They assume everything will go right. But when the market falls, they panic and lose money. Smart investors wait patiently for the right price. The intelligent investor thinks like a businessman, not a gambler. He asks, is this company worth more than what I am paying? If the answer is yes, and the gap is large, he buys confidently. If the price is too close to the real value, he waits. No pressure, no hurry. Because patience is also profit. Margin of safety is not about greed. It is about protection first, profit later. Remember this forever. You don't make money by taking big risks. You make money by avoiding big mistakes. And margin of safety is your strongest financial shield. It keeps you calm during crashes and confident during uncertainty. In investing, safety is power, and power creates long-term wealth.
Chapter 4. Defensive versus Enterprising Investor. In the world of investing, not everyone should follow the same path. Benjamin Graham clearly explains that there are two types of intelligent investors, and both can succeed if they understand themselves. These two types are defensive investor and enterprising investor. The biggest mistake people make is choosing style based on ego, not personality. Shield. The defensive investor is someone who wants safety, stability, and peace of mind. This type of investor prefers low risk, does not want daily stress, avoids constant monitoring, focuses on long-term steady growth. He invests in strong, well-known companies, index funds, and blue-chip stocks, stable businesses with regular profits. He is not interested in quick money. He is interested in safe money that grows slowly and surely. The defensive investor's goal is simple. Protect my capital first. Growth will follow. This style is perfect for busy professionals, beginners, people who don't enjoy analyzing stocks daily. Magnifying glass. The enterprising investor is more active and deeply involved. This type of investor does deep research, studies balance sheets, looks for undervalued stocks, takes calculated higher risks. He spends time understanding company fundamentals, management quality, and future growth potential. He is ready to put effort, time, and mental energy. But with this, he also expects higher returns. However, higher reward only comes with strong knowledge, discipline, and emotional control. Without these, this style becomes dangerous. Scale. The real lesson. The book does not say one is better than the other. It says, choose based on your nature, not your pride. Many people try to act like enterprising investors just to look smart, but they don't have patience or time. Result? Losses and frustration. An intelligent investor is honest with himself and asks, how much time can I give? How much risk can I handle? Can I stay calm during market falls? Your investing style must match your life, your mindset, and your discipline. Brain. Remember this. Defensive investing equals less stress, stable growth. Enterprising investing equals more effort, more opportunity. Both are powerful, but only when chosen wisely. Because in investing, success is not about showing off. It is about staying in the game for the long run. Choose smartly. Because the right style protects your money, and protection is the first step to wealth.
Chapter 5. The Danger of Market Emotions. In the stock market, the biggest enemy is not the market itself. The biggest enemy is your own emotions. Most people do not lose money because the company is bad.
They lose money because they cannot control greed and fear. When market is high, greed takes control. When market is rising and everyone is making profit, people start dreaming. They say, "This stock will double fast. I should invest more before it goes higher. Everyone is earning. Why not me?" This is greed talking, not intelligence. People buy without thinking. They forget research, they ignore price and real value. Result? They enter at the highest price, and when market falls, they suffer. When market crashes, fear takes over. When the market goes down, the same people start panicking. They say, "Everything is collapsing. I will lose all my money. Sell everything now." This is fear talking. Instead of seeing opportunity, they see danger. Instead of thinking long-term, they think only about today's loss. And they sell at the lowest price, exactly the wrong time. How intelligent investors think. Intelligent investors behave differently. When market is high, they become careful. They ask, "Is this stock overpriced? Is the value really this high?" When market is low, they stay calm. They look for good companies available at cheap price. They understand one truth clearly. Market emotions change, but business value takes time. They do not react, they respond with logic. The golden balance. Greed whispers, "More, more, faster." Fear screams, "Run, save yourself." But intelligence says, "Be patient, be rational, stick to the plan." The market rewards those who can stay calm when others are emotional. Final lesson. High market is not a signal to go crazy. Crash market is not a signal to run away. Both are tests of your mindset. Because in investing, the person who controls emotions controls his future. Greed makes you blind. Fear makes you weak. But calm thinking makes you wealthy. An intelligent investor always chooses calm over chaos.
Chapter 6. Long-term thinking wins. In the stock market, most people want fast money. They want profit in days, in weeks, sometimes even in hours. But this thinking is the biggest reason why they lose. The market does not reward rush. The market rewards patience. Short-term traders versus long-term investors. Short-term traders think like this: I will buy today and sell tomorrow. I need quick profit. I can't wait too long. They watch price every minute. Their mind is always stressed. Every small fall scares them. Every small rise excites them. This creates emotional decisions, not smart decisions. Long-term investors think differently. They say, I believe in this company. I will give it time to grow. I am here for years, not days. Wealth is slow, but strong. Real wealth is not created in 1 year. It is created over 5, 10, 15, even 20 years. Good companies grow slowly but steadily. Profits increase, business becomes stronger, and your investment grows naturally. This growth is powered by one magic force: compounding. When you stay invested for a long time, your money starts making money, and then that money makes more money. This is how silent millionaires are made.
Chapter 7. How to analyze a stock properly. Most people buy stocks like they buy vegetables in the market. They listen to neighbors, YouTube tips, WhatsApp messages, and random hot calls. This is not investing. This is blind gambling dressed as confidence. An intelligent investor never follows noise. He follows numbers, logic, and business reality. If you want to analyze a stock properly, stop asking, which stock will go up fast? Start asking, is this a strong company for the long run? Focus on company fundamentals. Fundamentals mean the real health of the company. You must understand, what does this company do? How does it make money? Is its product or service really needed in the market? A good company solves a real problem. It has steady customers. It has a clear business model. If the business is weak, no chart or tip can save your money. Earnings stability. Check whether the company is earning profit consistently. Is profit growing year after year? Or is it jumping one year and falling the next? Stable earnings mean the company is reliable. Unstable earnings mean risky future. A company that earns regularly is like a strong salary person. A company that earns sometimes is like a gambler. Which one would you trust with your money? Debt levels. Debt is like a heavy bag on the company's back. Some debt is normal, but too much debt is dangerous. If a company earns 10 rupees but pays 8 rupees as loan interest, how will it grow? High-debt companies suffer badly during market crash or economic trouble. Low-debt companies survive and even grow. Always ask, can this company easily repay its loans, or is it drowning in them? Business quality. Business quality means strong brand, good management, competitive advantage, trust in market. Ask yourself, will this company exist 10 years from now? Or is it just a temporary trend? Quality business equals safe future. Weak business equals risky trap. Not on rumors or hype. Never invest because everyone is buying it. My friend said it will double. This stock is trending. The market is full of noise. Smart investors use silence and research. Price can lie. Trend can lie. Tips can lie. But business reality never lies. Final lesson. Real stock analysis is not about prediction. It is about understanding. Don't chase fast money. Choose strong companies. Because when you invest in quality, you sleep peacefully. And peaceful investors always win in the long run.
Chapter 8. Diversification. Don't put all eggs in one basket. Many investors make one dangerous mistake. They put all their money in just one stock, one sector, or one idea. They believe this will definitely go up. But the market does not care about your belief. When that one stock falls, their entire savings fall with it. This is why intelligent investors follow one golden rule: never put all your eggs in one basket. Diversification simply means spreading your money across different places instead of one single option. You invest in multiple companies, different industries, and sometimes even different asset types like stocks, mutual funds, or bonds. This way, if one investment fails or performs badly, the others balance your loss. Think like this.
If you invest all your money in one company and it crashes, you are finished. But if you spread your money into 5 or 10 strong companies, even if one goes down, the rest keeps supporting your wealth. This is not about fear. This is about smart protection. A smart portfolio is like a safety net. It protects you during market crashes, bad news, and unexpected events. When one stock is weak, another may be strong. This balance keeps your wealth stable and your mind calm. Diversification does not mean buying random stocks. It means choosing quality companies from different sectors like banking, IT, pharma, FMCG, energy, and infrastructure. This reduces risk and increases long-term safety. Many people say, "I want maximum profit, so I will go all in on one stock." This thinking is emotional, not intelligent. Real investors focus on survival first, profit second. Because if you survive long enough in the market, profit automatically comes. Diversification is not about making you rich overnight. It is about making sure you don't go broke. And in the world of investing, survival is the real victory. When others lose everything due to one bad decision, the diversified investor stays standing. That is the power of intelligent investing.
Chapter 9. Inflation and its silent threat. Most people think the biggest danger to their money is the stock market, but the real silent enemy is something else. It is called inflation. Inflation slowly reduces the value of your money without making any noise. You don't see it clearly, but you feel it in your daily life. The tea that cost 10 rupees 5 years ago now costs 20 rupees. The movie ticket that was 150 rupees is now 300 rupees. Your money did not change, but its power reduced. This is what inflation does. It slowly eats your savings. If your money is just sitting in a savings account with low interest, it is not growing. In reality, it is losing value every year. You may feel safe because the number stays the same, but your purchasing power is becoming weaker. This is why intelligent investing is not only about earning more money. It is about protecting the value of your money over time. If inflation is growing at 6% per year and your savings account gives only 3%, you are actually losing 3% every year. This loss is silent but powerful. Historically, stocks have beaten inflation in the long run. Good companies grow their profits, increase prices, and expand their business. As they grow, your investment also grows. This helps your money stay ahead of rising costs. That is why intelligent investors do not fear investing. They fear keeping their money idle. Inflation punishes people who do nothing. It rewards people who plan ahead. Real investing is not about becoming rich fast. It is about making sure your future self can live comfortably. And the only way to fight inflation is to make your money work, instead of letting it sleep and slowly die. In simple words, if you don't invest, your money becomes weaker every year. If you invest wisely, your money grows stronger over time. That is the silent but powerful truth of inflation.
Chapter 10. Intelligent Portfolio Strategy. Investing is not just about picking 1 or 2 stocks and hoping for the best. To succeed, you need a smart portfolio strategy. A portfolio is the mix of all your investments, stocks, bonds, funds, or other assets, designed to grow your wealth while protecting it from risk. The first rule is balance. Your portfolio should have a combination of growth assets, stocks or businesses that can increase in value over time. These give you higher returns, but can be more volatile. Safety assets, bonds, fixed deposits, or stable companies that protect your money. These provide stability when the market goes down. A smart investor never puts everything in one type of asset. Too much growth, and your portfolio can crash during market dips. Too much safety, and your money won't grow enough to beat inflation. Rebalance regularly. Markets change. Some assets grow faster, others slower. Over time, your portfolio balance shifts. A wise investor rebalances by selling part of assets that have grown too much, buying more of undervalued or safe assets. This keeps your risk and reward in control. It is like adjusting the weight in a seesaw to keep it balanced. Discipline over excitement. The stock market can be very emotional. People get excited when prices rise and fearful when prices fall. But intelligent investors stick to their plan. They don't chase short-term trends. They don't panic during crashes. They don't follow hype. Discipline beats excitement every time. A well-planned portfolio is designed to survive market ups and downs. The investor's job is to stay patient and consistent. Final lesson. An intelligent portfolio is not built overnight. It is built with balance, discipline, and regular attention. Growth assets increase wealth. Safety assets protect it. Rebalancing keeps it steady. Discipline keeps you calm. This is the strategy that separates smart investors from gamblers. It is not about luck. It is about planning, control, and patience.
Chapter 11. The Psychology of Successful Investors. Investing is not just about numbers, charts, or stock prices. The most important part of investing is your own mind. How you think, how you react, and how you control your emotions determines whether you succeed or fail in the market. The best investors are masters of their emotions. They don't let greed or fear control their decisions. They understand that the market will rise and fall, but these movements are normal, not personal. Patience, calmness, and logic are their tools, not excitement or panic. Qualities of successful investors. 1. Patience. They don't expect profit overnight. They wait for the right opportunities. They give investments time to grow. They understand that wealth comes slowly, like a tree growing from a seed. 2. Calmness. They stay calm during market crashes and corrections. While others panic and sell at the lowest price, they remain steady and even see opportunity in fear. 3. Logic. They make decisions based on facts, research, and reasoning. They do not follow tips, trends, or emotional impulses. Every investment has a reason, a plan, and a strategy. 4. Detachment from hype. They ignore the noise around them. Just because a stock is trending or everyone is talking about it does not mean it is a good investment. They focus on value, not popularity. Mindset over knowledge. Many people believe that investing is all about knowledge, knowing companies, numbers, and markets. While knowledge is important, mindset is more important. You can know everything about a company, but if you panic during a market drop, you will lose money. The intelligent investor trains the mind to stay disciplined, think logically, and act patiently. They understand that the stock market tests emotions more than intelligence. Final lesson. The stock market is a battlefield of emotions. Greed tempts you to buy too high. Fear tempts you to sell too low. A successful investor wins not by following the crowd or making quick decisions. They win by staying calm, patient,
and logical. Control your mind, and the market will obey. Lose control, and the market will punish you. In investing, the strongest muscle is not your money, it is your mind.
Chapter 12. The True Meaning of Intelligent Investing. Many people enter the stock market thinking the goal is to get rich quickly. They dream of doubling or tripling their money in months. But Benjamin Graham teaches us a very different truth. Intelligent investing is not about fast riches. The real goal is avoiding foolish mistakes. Every loss, every panic, every rushed decision can destroy your wealth faster than you can earn it. The intelligent investor focuses on protection first, growth second. He knows that small, consistent, wise decisions over time create true wealth, while chasing quick profits often leads to regret. Consistency over luck. Luck may help someone once or twice, but it does not last. Success in investing comes from discipline, patience, and consistent decision-making. The intelligent investor follows his strategy, sticks to his principles, and makes calculated choices, no matter how exciting or scary the market becomes. Over time, these consistent actions compound into real wealth. Investing is a lifelong journey. Investing is not a one-time activity. It is a lifelong journey of learning, discipline, and control. The market will always test you with highs and lows. Companies will rise and fall. Economies will boom and crash. But if you develop the right mindset, your decisions remain steady. You learn to think logically, stay calm during uncertainty, and avoid common mistakes that destroy wealth. Final lesson. Intelligent investing is simple but not easy. It is not about chasing trends. It is not about fast profits. It is about patience, consistency, and emotional control. If you follow these principles, the market stops being a gamble. It becomes a tool to grow your wealth safely and steadily. Remember, real investing is not a race to get rich. It is a disciplined journey to stay rich, grow steadily, and protect your financial future for life.
Be smart, not lucky. The stock market is not easy. It will test your patience, confuse you with constant news, and challenge your emotions at every turn. Prices will rise and fall. Headlines will scream fear and excitement. Most people will react, panic, and make mistakes. But an intelligent investor behaves differently. He chooses discipline over drama, logic over greed, and patience over panic. He does not chase trends. He does not follow the crowd. He sticks to his principles, studies his investments carefully, and makes decisions based on facts, not feelings. By doing this, you don't just become an investor. You become an intelligent investor. Someone who survives market storms, avoids costly mistakes, and steadily builds wealth over time. In the stock market, intelligence beats speed, and patience beats prediction. The game is not about luck. It is about thinking smart, staying calm, and playing the long game. Your future in investing is not about chasing hype. It is about mastering your mind and your money.